Hello, traders. This is the Trading Cyborg, and welcome again to another episode. Now, my job, my day job, is that I am a trader, but my purpose is to spread wisdom about trading. So today, I'm spreading a new piece of wisdom on how to master your intuition. Now, before we continue, if you like a mentorship from me, I have attached my number on the description so you can get in contact and we can add you to the community. Okay, so that aside, how to master your intuition. Now, this issue of intuition, I began looking at it seriously after I listened to a podcast of this guy, Jeffrey. So you may or may have not heard about this guy. You may or you may not have heard about this guy. So this guy is called Jeffrey Epstein. And this guy, together with some other naughty guys, had a small island called the Epstein Island. So in that island, they will bring women, young women, underage women of even 10 years old, and then they will have sex with them. So this guy was the ringleader. This guy was the ringleader of those naughty things which were happening. And they are not very naughty because a lot of women died in that process. Okay, but now, why did I mention this guy? This guy was a trader. So eventually this guy was arrested, and then this guy served for his offenses, and then he later died. But before he died, he released a video being interviewed, because this guy was a trader. So Jeffrey Epstein was a trader, and in that 2-hour interview, he is asked one simple question: what do you think makes a good trader? And Jeffrey Epstein said, what makes a good trader is intuition. So ladies and gentlemen, I decided to go deep into the rabbit hole to understand how we cultivate our intuition, whether we are already cultivating it unknowingly by the things we do, or we are chasing it away. I wanted to know, because it is good to have every kind of arsenal in this field. You have to be a warrior. You have to have every kind of trick there is in this book, in this game. And one of the tricks is mastering your intuition. So I have prepared this lecture for you based on what this guy, Mr. Jeffrey Epstein. So let us begin. So if you are listening to this right now, you have probably already had the experience. You knew something in your gut said, this trade must be wrong. By the way, I cannot even tell you how many times I have felt, many times, and then that trade ended up to be a bad one. Or this setup, I've been waiting for this setup my entire career, and then when you just get in, it becomes the best decision you ever made. That feeling, that knowing, that is usually not superstition. That is not weakness. It is not even luck. Okay? It is not even luck. It is your brain doing something very extraordinary. something that took decades of neuroscience to even begin to understand. And in this lecture, we are going to cover the 10 specific numbered pillars of trading intuition, each one grounded in research, psychology, and market reality, and the lived experience of some of the greatest traders who ever walked a trading floor. So the first thing we understand is, we have to ask ourselves is, what is intuition? What is intuition? What do you think intuition is, my dear listener? So we shall start in 1974. In 1974, there was a guy called Daniel. By the way, my name is Daniel also, so I'm not only trading cyborg. My name is Daniel. So in 1974, we had a guy called Daniel Kahneman and Amos Tversky, something like that. Tversky. And these guys won in 1997. In 1974, they won a Nobel Peace Prize. So now maybe you are we want to get inside the why did they win that Nobel Peace Prize? Because they discovered two things: that the human mind operates on two systems. So your mind right now is operating on two systems. We have system one, where you are fast. Your system one is fast, it is automatic, it is emotional, it is instinctive. And then your system 2 is slow, deliberate, logical, and analytical. So you have two systems. Now, most of our trading education is designed entirely around system 2. Okay? Starting from risk reward ratios, TL calculations, backtest, all these are system 2, because they teach us to, for example, we use risk reward ratios to understand how much I am going to risk and how much I am going to lose. That is logical. We use backtest to find out data from 10 years ago and try to use that same data in the next trades. Okay, so all these are system 2. But we have an uncomfortable truth that in live markets, under pressure with real money, system 2 is very slow. By the time you start being too logical in the market, or you switch on your analytical mind in the market, then you will always find out that you don't take that trade, because you begin questioning that trade. Is this a good trade? Should I take this trade? Sometimes even you are slow. Sometimes you are even slow, because you are using system 2. So by the time your analytical mind finishes processing the candlestick pattern, the move is already happening without you. Now this is where system 1 is important. So system 1, This is now what we call intuition. Now this is where it becomes useful. It becomes not just useful, but very important for your trading. Now, here is where most people go wrong. They think that intuition is the opposite of analysis. Absolutely not. Intuition is compressed analysis, as we shall find out in this lecture. It is what happens when system 2 patterns become so embedded through repetition and experience that system 1 can access them instantly. So intuition is not a shortcut to experience. It is experience which is compressed, encoded, and made rapid. So in 1992, a guy called Gary Klein spent years studying what we call decision making in high stakes environments. That is firefighters, military commanders. What happens when there is war? War has broken out. How do those people think during those times? ICU nurses. What happens when someone is brought in when they are about to die? How do these nurses think? And what he found was very, very interesting. The first thing he found is that these experts were not making decisions by evaluating multiple options. They were pattern matching, unconsciously recognizing a situation as similar to thousands of previous situations and acting accordingly. He called this recognition primed decision making. So this is called recognition primed decision making, RPD. And the traders who survive long in their careers in these markets develop this particular skill, recognition primed decision making. A trader who has watched GBP USD for 10,000 hours. 10,000 hours. Imagine watching GBP USD. Watching GBP USD for 10,000, you need a lot of patience. A lot. But it is going to serve you. So a trader who has watched GBP USD for 10,000 hours does not need to calculate anything when they sense the open is wrong. They have seen that open before, maybe even 200 times, 500 times, and then their nervous system remembers what comes next. So that is intuition, and it is trainable. So we go to pillar 2. Pillar 2 is meditation. Let me ask you something, traders. Have you ever had a trade idea that you knew was right, then doubted it? You saw the setup, you knew the entry, and then you waited. And while you waited, the noise came in. Those analytical questions began disturbing you. You began asking yourself very many questions. Then you went on Twitter, and then you saw a guy who was saying the market was going the other way. And then your trading friend told you he is going now short, and then you are going long. Then in the long run, you never made a decision. You paralyzed yourself. And that is how a noisy mind does to intuition. It buries the intuition completely. So meditation is not a spiritual practice when we talk about trading. It is a performance tool. So let me tell you the science of meditation. So that we cannot be just talking for the sake of talking. So in 2011, a study from Massachusetts General Hospital measured the brains of 16 participants after an 8-week mindfulness based reduction program. Okay, and the results, so these guys, they did meditation for 2 months. 2 months. And in those 2 months, they discovered something very interesting, that there was an increase in cortical thickness in the prefrontal cortex. So the prefrontal cortex is the region responsible for decision making. And then there was also a decrease in the size of the amygdala. This is usually the region responsible for fear-based emotional reactions. So you can hear what this guy is saying, that after a 2-month meditation practice, the participants showed an increase in cortical thickness, which is a region responsible for decision making, and a decrease in the size of amygdala, which is the region responsible for fear-based emotional reactions. So when the amygdala decreases, your fear-based emotional reactions also decrease in that process of meditation. So imagine what this means for a trader. 8 weeks, which is around 56 days. And then your brain is physically and measurably different, more capable of clear decisions and less reactive to fear. Okay? So here is the protocol that works for traders specifically. So I dug deep into this meditation, and it is very simple. Very, very, very simple, by the way. So in the morning, when you wake up, 15 minutes before screens come on, or 15 minutes before you even open your phone to check, get chats, or to get on Facebook, or to get anywhere, you have to set aside 15 minutes for yourself to meditate, to look inwards, because at the end of the day, we are trying to master ourselves. All traders know this. We are trying to master ourselves, and what I am teaching you here is how you are going to master yourself as a trader. Okay? So in the morning, the meditation practice is very simple. You sit still, okay? Then you start breathing. And then you watch your thoughts. But don't get Don't get lost in them. So what you do, whenever your thoughts seem to take you away, you bring your focus back to your breathing. So bring back your focus to your breathing for 15 minutes. Continue and don't give up. Just continue. Your focus always on your breath. When a thought arises, don't feel bad about the thought. Don't judge yourself. Just observe the thought and then go back to breathing. Okay? It is time to go back to your mind, by the way. So there's this guy called Ray Dalio. Let me show you Ray Dalio. This is Ray Dalio. So Ray Dalio is the founder of Bridgewater Associates, one of the largest hedge funds on earth. He has credited transcendental meditation, what I am talking about, with being fundamental to his success as a trader and an investor, and he has practiced it daily for over 40 years. This is not a coincidence, this is causation. The quiet mind hears the signal, the noisy mind only hears the noise. So this guy has practiced transcendental meditation. So transcendental meditation is bringing your thoughts, bringing your awareness to your breath. So as you breathe in, you observe your breathing in, and when a thought arises, you observe the thought, then you go back to breathing. Okay, it's a bit hard when you start, but by the time you hit 30 minutes, you just start from 5 minutes, 10 minutes, then 20 minutes, then you continue building up, and you'll see the results you're looking for. Number 3. So we went from pillar 1. Pillar 1 was about understanding intuition, and then pillar 2 was about meditating, building the quiet mind. And then pillar 3, now in developing your intuition, is deliberate experience accumulation. So pillar 3 is deliberate experience accumulation. Okay, so traders, here is the uncomfortable truth about intuition that most trading gurus will never tell you. You cannot fake trading intuition. In fact, you cannot even shortcut it. You cannot even buy it. You have to earn it through repetition. So you have to earn intuition through repetition. So in 1993, a guy called Anders Ericsson, so this guy here, Anders Ericsson, he was a psychologist. So Anders Ericsson published his now famous research on expert performance. His conclusion was that world-class expertise in many domains requires approximately, oh my goodness, approximately 10,000 hours deliberate practice, not passive exposure. Deliberate practice Practice with feedback, with challenge, with intentional reflection. Now, here is where traders make a very critical mistake. They log screen time. They think showing up is the same as deliberate practice. It is not. You can stare at a chart for 20,000 hours and never develop genuine intuition if you are not deliberately coding patterns in your brain. So, what does deliberate practice look like in trading? So, what does deliberate practice look like? First, number one, you pick one instrument. Not 20, not 30, 1, not even 15, 1. Pick Euro USD. So, wherever Euro USD goes, you go there. If Euro USD goes north, you go north. If Euro USD is ranging, you range. If Euro USD is crying, you cry. If Euro USD is... And this is where we go wrong. Many traders. For example, myself, I began trading GBP USD. Then I moved to USD. Then I moved to gold. Then I moved to... Then I went to gold again. Now I'm back to GBP USD. I'm sticking with GBP USD. So whatever your market is, go deep. Know its personality, how it moves on Monday morning versus Friday afternoon, how it behaves in FOMC, how it moves when volume is thin. Second, study historical replay. Every serious trading platform has a function, even MT4. Go back to MT4. Look for something, maybe there's something you're looking, study how it behaves based on your price action knowledge. Every serious trading platform has a replay function. Go back to 2008, 2020, 2022 and replay critical market sessions in real time, making decisions as if you are in the moment, then reviewing outcomes. Because at the end of it, some of these things will require you to invest. Okay? But if you truly want to make it in trading, you have to invest in some of these softwares. You have to invest. You have to invest. Researchers at the Chicago Mercantile Exchange found out that traders who used historical replay as part of their practice routine hit profitability targets 40% faster than those who did not. Imagine. So those who used historical replay hit profitability targets 40% faster than those who did not. Number 3. So number 2, we have said you study historical replay. So go back to 2008, 2002, 2022, and then you go back to, then number 3, you journal with precision. I don't know whether I've produced a video on journaling, but I think I have. I will attach that video there. So you journal. What did I feel? What did the tape look like? What were the conditions? What did I not see that I should have seen? You're encoding an narrative. Okay? Okay, so let me repeat those questions. What did I feel? What did the tape look like? What did I not see that I should have seen? Okay, so if you spend at least 4 hours of the day deliberately focused practice, replaying, reviewing, journaling, live trading with reflection, you hit what? You'll hit 10,000 hours in about 7 years. Imagine. So this is in the morning and in the evening. Morning, evening, morning, evening, morning, evening, morning, evening. That is the investment required for deep intuition. There's no app, there's no shortcut, but there's a path. So this is the path. So Paul Tudor James, let me show you Paul Tudor James. Paul Tudor James. So this guy, he has spoken how he would review his trades with obsessive detail. Not just reviewing, but reviewing his trades with obsessive detail. My God, I'm also learning. Sometimes spending more time in post-trade analysis than in actual trading, because he was not just accumulating experience, he was deliberately encoding it. Okay? Now, let us go to pillar 4. So pillar 4. Pillar 4 is managing emotional noise. So this is a somatic signal versus fear. So one of the most important distinction in psychology, and by the way, nobody talks about this. There's a feeling you get when a trade is right, and there's a feeling you get when you're afraid. These feelings can feel identical in the body. Okay. For example, when I spot a good trade and I set up my first, I feel confident. I know this is a good trade. Okay, so these feelings can feel identical in the body. So the feeling of when a trade is right and the feeling of being afraid. So an elevated heart, tension in the chest, a kind of restlessness, a narrowing of focus, both fear and intuitive readiness can produce all of this. And if you cannot tell the difference between them, you'll either trade out of fear, which will destroy you, or you'll trade out of you'll mistake fear for intuition, which will also destroy you. Now, this distinction is what neuroscientist Antonio Damasio called the somatic marker hypothesis. So somatic marker hypothesis. So this guy, Mr. Damasio, studied patients with damage to the prefrontal cortex, and we said the prefrontal cortex is the region in the brain which is responsible for decision making. So he studied patients with a damaged prefrontal cortex. So these people who are intellectually intact, so they never had any problem with reasoning, but they had lost the ability to feel emotional signals in their body. So you find a guy is okay, but he cannot feel. So what was the result of this experiment? They became catastrophically bad decision makers. They would agonize for hours over trivial choices. They would not integrate past consequences into present decisions. So in short, their intuition was lost. They had no intuition. And his conclusion was very radical. Emotion is not the enemy of good decision making. Emotion is necessary for good decision making. The body keeps score of what works and what does not. And those somatic signals are critical data. But here is the key, you must learn to read. Here is the key. You must learn to read this signal correctly. So how do you distinguish intuitive signal from fear noise? Okay? So how to distinguish intuitive signal from fear noise? So intuitive signal tends to feel clear. It arrives very quickly. It arrives very quickly. It has a quality of certainty. So sometimes I feel very certain about this trade. So it is not excitement, it is not urgency, but clarity. You feel some certain, you are very clear. And it often comes with a kind of stillness. A good trader once described it to me, and he told me, when I have a real trade, I feel calm. When I feel urgent, I know I have to wait. So intuition, you are not excited, there's no urgency, just clarity. But fear noise tends to feel scattered. It arrives with urgency. It often includes obsessive thinking, running through worst case scenarios, second guessing, FOMO. It has an anxious quality. It often comes after a loss or when position sizing is too large. So first thing to develop your intuition is to use the right kind of risk. So for you to develop your intuition, use the proper risk. If you're risking 50% of your account, then your intuition will never develop the way it should be developing, because it is going to be clouded by fear. So this is something I want you to start practicing today. Before every trade, take 30 seconds, breathe, and then ask yourself, is this signal clear or scattered? Am I calm or am I anxious? Then keep a record of your answer. Okay, let me repeat this. Before every trade, take 30 seconds, breathe, then ask yourself, is this signal clear or scattered? Am I calm or am I anxious? Then keep a record of your answer. Because then after over 100 trades, you'll begin to see patterns. Which inner state correlated with your best outcomes and which correlated with your worst. So you have to start tracking today. So a research conducted by Dr. Andrew of MIT tracked physiological responses, that is, heart rate, skin conductors, cortisol in professional traders over 2 weeks. He's finding experienced traders, listen to this, experienced traders did not have lower emotional responses than novices. They had better emotional regulation, meaning they felt the emotion, but they did not act from the unprocessed version of it. So the goal is not to eliminate the feeling, the goal is to read the feeling with precision. The goal is to read the feeling with precision. So you read that okay. So now we enter into pillar 5. So pillar 5 is there. Trading journal as an intuition training tool. So let us talk about the journal. Not as a record keeping exercise, not as a compliance tool, as a neuroscience intervention. When you write about an experience, when you narrate what happened, what you felt, what you saw, what you thought, you're not just recording data. You're consolidating memory. You're transferring information from working memory into long-term storage. You're quite literally wiring patterns in your brain. Alright? In 2003, a study by a psychologist called James Pennebaker at the University of Texas found out that people who wrote expressively about their experiences showed measurable improvements in immune function, mood regulation, and decision-making accuracy compared to those who did not. So writing processes experience. Writing, that's a very important, writing processes experience. And processed experience becomes intuition. So what should be part of a good trading journal? So trading journal, trading journal. So trading journal, okay. So a high performance trading journal has 4 components. Component 1, the setup, narrative. So before the trade, what do you see? What is the market telling you? What is the macro environment? That is, what are the higher time frames saying? Okay, that is step 1. Okay, that is step 1. What does the tape look like? That is, how does the market, what do you think that what is happening? So now I want you to write it in prose. It is not easy by the doing these things, but once you start, remember we want to be among the top 5. Write it in prose, not just bullet points, because your brain is going to process differently. Number 2, the emotional state log. So rate your emotional state on a scale of 1 to 10. 1 being calm, completely calm, 10 being completely reactive. Then mark your confidence level. Mark whether you are trading from a place of clarity or from a place of needing to make money. This data collected over months will reveal your psychological edge and your psychological sabotages. Component 3, the post trade debrief. And we should not just check the results, we also need to check the process. Did you follow your plan? If you deviated, why? What did the market do that surprised you? What did you do right that you want to remember? What will you do differently? Okay? That is process. Component 4, the weekly pattern review. So I will also pin the weekly pattern review video. So every weekend you read your week, you look for patterns, not in price but in yourself. Are you losing more on Fridays? Are your best trades coming in the first hour of the market open? Are you more profitable when you have slept 8 hours versus 6? This is the data. This is the data we want. Personal, intimate, irreplaceable data that no algorithm is going to come up, is going to generate for you. There's this guy called Market Wizard Mark Minervini, who has kept a detailed trading journal for every trading day of his career, spanning over 30 years. He credits the journaling practice as foundational to the pattern recognition that allowed him to achieve returns in excess of 220% annually during his peak performance years. So Mark Minervini. So this is Mark Minervini. Okay. So now we move to pillar 6. Pillar 6 is risk management as intuition. As intuition protector. I think I talked about this earlier, but let us expound on this more. So most traders think that risk management is a financial tool, a way to limit losses. And actually it is, but there's a deeper reason. There's a deeper reason why professional risk management is non-negotiable, and it has to do with preservation of our intuitive capacity. Here is what happens when your position sizing is very large. What happens when you are over leveraged? Number one, your cortisol, which is your stress hormone, goes up. That is spikes. Okay, so cortisol is a primary stress hormone, and it floods your system when you are overexposed. And cortisol does something specific to cognition. It suppresses the prefrontal cortex, the very region responsible for integrating intuitive signals with rational assessment. Okay? So, it deactivates the amygdala, which is the fear center. In plain language, over-leveraging makes you stupid. Over-leveraging makes you stupid because it turns off the very mental hardware that intuition relies on. This is why professionals trade small relative to their account. Not because they are timid or they are afraid. It is because they are protecting their cognition function. Okay? Now, we have some research also. Some more research here. And this research was conducted by Dr. Steenbarger. His name is Dr. Steenbarger. Dr. Brett Steenbarger. This is one of the foremost performance psychologists. Working with traders. So, what does this guy say? At 1%, risk per trade, we are able to preserve our cognitive at 2% per trade. Stress responses begin to impair system 1. So at 2%, stress response begin to impair system 1. But remember, this is for people with a lot of capital. For me, the only time I'll feel bad is when my risk is more than 3% or 4% of my capital. So for this, it will depend on you. If your risk tolerance is not very high, then you have to find a threshold where you are okay, where you don't start stressing and start disturbing your trade for nothing. Okay? So think about what this means, that your maximum risk per trade for preserving your intuitive clarity is $500. That sounds small, but consider this. If you compound at 2% per month, which is exceptional, you double your account in approximately 36 months. The math of small consistent edges is the math of preserved mental function. There's this guy called Ed Seykota, one of the original turtle traders and one of the most successful systematic traders of his era, famously said, risk no more than you can afford to lose, and also risk enough so that a win means something. So that balance, that sweet spot, is also the cognitive sweet spot where intuition performs best. So risk management is not the opposite of bold trading. It is the infrastructure that makes bold intuition possible. Number 7. So we enter pillar 7 now. Pillar 7. So pillar 7 is pattern recognition. So that is training the eyes. Training the eyes. So there's a story that traders in the old Chicago pits used to tell. They said you could always spot veterans, not by how loud they yelled, but by how still they were. While new traders were constantly moving, reacting, adjusting, the veteran traders would stand almost motionless, watching like lions, and then suddenly they would step in and trade every single time. These veterans had something that took years to develop, and this is called the genuine pattern recognition. It's not a chart pattern recognition that anyone can learn in a weekend. It's deep, multidimensional, context-aware pattern recognition. So let me explain the difference. So in the basic charts, the basic chart patterns that is let's say head and shoulders, or even something like fair value gap, identifying a fair value gap, identifying a double top. All these are system 2. You learn this from a book. You apply a checklist. So this is a rule based recognition. It has value, but it is not intuition. Deep pattern recognition says this kind of move at this kind of day with this kind of volume profile after this kind of news reaction in this kind of macro environment tends to resolve this way. It integrates 5, 10, 15 variables without consciously listing them. So that feeling, so your pattern recognition arrives as a feeling, not as a rule-based recognition. You feel something that this setup is right or something is wrong. Something is very, very wrong. So how do you train this deep pattern recognition? Number 1, 10,000 chart projects. Set a commitment to review 10,000 historical charts, not casually but with a specific question. What happened next? Look at the setup, form the hypothesis, then scroll forward and see. Then do this systematically in batches of 100 over months. Researchers studying chess grandmasters who rely heavily on pattern recognition found that masters had stored between 50,000 and 100,000 board configurations in long-term memory. What? The trader who develops genuine pattern recognition, the traders who develop genuine pattern recognition are doing the same things with price action. Okay? So practice 1. The 10,000 chart project. So set a commitment to review 10,000 historical charts, asking yourself what happened next. Then look at the setup, form a hypothesis, then scroll forward and see. Then do this systematically in batches of 100 of a month. Number 2, the pre-market ritual. So every day before the market, spend 20 minutes not looking at the news, not checking positions, but reviewing what the market did the day before. Where was the volume? Where did price reject? Where did it accept? What were the key levels? You are feeling by doing this, you are feeding your pattern library. You are updating the data set. Number 3, the setup taxonomy. You create your personal taxonomy of setups, not generic ones, but the specific ones that you personally observed and traded successfully. You named them. You draw them. By the way, you must draw them. You describe their conditions. Having named, categorized patterns makes them accessible to System 1 in real time. Instead of your brain searching through formless experience, it can match to a named category. This is how experts think. Not in raw data, but in named structures. There's this guy called Jack Swagger. So Jack Swagger has written the Market Wizards, and he has interviewed a lot of them, and he has found out one thing. All of them were immersed in periods of market study, often very many years, before achieving consistent profitability. They were not born with better intuition, but they just built it. Pillar 8, which seems very easy, but many of us don't do very well. So pillar 8 is sleep, exercise, and the biological basis of intuition. So pillar 8 sleep and exercise. So sleep and exercise is very, very important. Okay? Because your brain is not a software program running on an abstract hardware. It is a biological organ, and it performs exactly as well as the body that houses it. So how well you sleep and how often you exercise will directly influence your trading decisions. So let's go with sleep first. So Dr. Matthew Walker is the author of Why We Sleep, has documented catastrophic cognitive effects of sleep deprivation. So at 6 hours of sleep, your decision making is impaired to roughly the level of mild intoxication. At 4 hours, the brain begins to lose its ability to consolidate new memories. So the lower you go, the worse it becomes, which means the experiences you had today do not wire into the pattern recognition circuitry tonight. The last point is critical for intuition development, and this point is memory consolidation. And this is whereby the process, the daily experience gets encoded into long-term pattern libraries and happens overwhelmingly during deep sleep, specifically during slow wave sleep and REM cycles. So REM cycles are the deep times, so we have 2 sessions of sleep, and one of it is the deep cycle. The deep cycle begins from 3 to 5 a.m. So 3 a.m. is when many people die, so that's called the REM cycle. And this is when intuition development is occurring. So if you're not feeding your intuition every day, then you are the problem. So the practical implication here, a 20-minute walk before your trading day is not a luxury. It's a cognitive preparation, tuning the instrument before the performance. Alright, so now we go to pillar 9, the most important of all. When to trust and when to question. Now we arrive at what may be the most nuanced and most important topic pillar for all. Everything we have discussed so far has been about building intuition, developing it, protecting it, training it. But there's a critical side, knowing when to question it. Because just like anything else, intuition can be wrong. And it can be wrong in specific, predictable, documentable ways we are going to mention here. The 3 primary failure modes of intuition. The 3 Number 1, confirmation bias. This is the brain's tendency to seek out and weight information that confirms what it already believes. So your brain is looking for reasons to believe a certain setup. So when you are deeply convicted in a trade, your pattern recognition system stops being objective. It starts filtering all incoming information through the lens of how does this support my position. Kahneman called this the inside view. That is, being so immersed in your own narrative that you cannot see the base reality of the situation. This is what we call forcing the market. Forcing the market to do what you want. So when you force the market to do what you want, you are looking for what we call a confirmation bias. And how do you fix this? Before any significant trade, explicitly seek out the strongest case scenario for your view. Read the bearish case if you are long, and then read the bullish case if you are short. Give the opposing narrative 5 minutes of genuine open consideration. So if you are looking to buy, look for reasons why it could be a sell. And if you're looking to go short, look for reasons why it could be a buy. That is, give the opposing narrative 5 minutes of genuine and open consideration, so that when you are taking that trade, you are almost 100% convinced that this trade is going to go my way. Okay, so this is training your cognition, your intuition part 1. So you have failure mode 2. So the first one was confirmation bias, that is trying to force the market to do what you want, and you have said the remedy for this is to seek out the strongest. So let me seek out the strongest case against your view. So if you are trading bearish, so you are convinced this is a bearish move, try to look for bullish reasons. Then if there are no bullish reasons, then your case must be very, very strong. And then vice versa, if you are trading bullish, look for bearish reasons. If you give yourself these 5 minutes every day, you'll discover that you are taking trades based on real intuition. Right? So number two, all right, I'm back. Number 2, one of the 3 primary failure modes of trading intuition is anchoring to your first information. What does this mean? The price you see in the morning, that is the first number, the first chart level, the first analyst note, disproportionately influences all subsequent judgments, and it is one of the most powerful and underappreciated biases in all of trading. Okay, so this means when you wake up in the morning and then you see a certain candlestick, you begin getting a bias. Okay, so you see a certain candle, then the whole day, you are biased in a specific direction. So how do you tackle this? So the way to tackle this, number 1, delay your first chart look. So I normally say, if the session opens at 9, because it opens at 9, start trading at 10 a.m. Now this is what we call the kill zone hours. So that you can get the feel of the market. And then the last one is building the intuitive. So now we're in pillar 9 now. We're in pillar 10, sorry, pillar 10. Building the intuitive trading identity. So we have covered 9 pillars, and each one has been a practice, a technique, a tool. But there is a 10th dimension that operates above all of them, and without it, none of the other 9 will stick. That dimension is identity. Identity. Now, not what you do, who you are, because here's the reality that most trading coaches skip over. All the meditation, all the journaling, all the pattern, these practices will be abandoned under stress if your identity does not support them. If deep down at the identity level you believe you're a gambler trying to get lucky, your behavior will eventually reflect that belief regardless of how many techniques you have learned. So the first thing is to identify as a serious trader, not a gambler. The traders who develop world-class intuition don't just practice being disciplined. They are disciplined. It is not what they do, it is what they are. The practice flows from the identity, not the other way around. So, how do you build an intuitive trading identity? We have 3 practices. Number 1, morning affirmation. And we have a specific based affirmation. Say this: I am a student of the markets. I honor my process. I trust my preparation. I trade my plan. And then repeat again: I am a student of the markets. I honor the process. I trust the preparation. I trade my plan. These statements, when repeated daily, code values into the self-concept. So do this morning and evening. 5 minutes before you sleep and 5 minutes after you wake up. And the self-concept governs behavior under pressure in ways that conscious rules cannot do. Then we have the practice 2, the trader autopsy. When you break your rules, when you overtrade, when you size up out of FOMO, when you ignore your stop, you do not punish yourself. You conduct an autopsy. You ask, what belief was I operating from in that moment? What story was running in my head? Because every behavior has a belief behind it, and you cannot change behavior sustainably without examining and updating the belief. Practice 3, study your heroes with depth. Most people, by the way, read Market Wizards for the trading tips, but professionals read it for identity insights. How did these people think? What values did they protect? What did they refuse to do? Not because a strategy said not to, but because of who they are. Find the traders whose character you admire, not just P&L. Identity is partly built through imitation of admired models. So, we are done. Let us bring these. It was a long lecture, but it is worth it. So, as we close, let me remind you of these pillars. The first one we have said meditation. The second one we have said deliberate. Experience accumulation. The third one we have emotional signal literacy. The trading journal. We have risk management. We have number 6. We have deep pattern recognition training. Then we have number 7, sleep and exercise. Sleep and exercise. Number 8, we have knowing when to question intuition. Then building intuitive identity. Then number 10, we have integration. So traders, I want you to understand one thing as we finish, which is the final thought. These markets are not going anywhere. They'll be here today, they'll be here next month, even the next decade. The question is not whether opportunity exists in the market. Opportunity will always exist. The question is whether you will be equipped to recognize it, execute it, and protect it consistently over a long arc of your career. The traders who last don't just win. They build enduring success and are the ones who invest as seriously in their inner game as in their outer game. They are the ones who build their psychological infrastructure to hold great trades, cut bad trades, learn from both trades, and return to the screen next day with clarity, curiosity, and conviction. Very important. This is what mastering intuition means. Not becoming psychic, not eliminating risk, not always being right. It means building a mind so deeply aligned with the nature of markets that your first sense of a situation is more often right than wrong. And it means building the discipline and the identity to act on it when it speaks. So, thank you for your time and thank you for this moment. I've attached my number down below. If you want a mentorship, look for me. Thank you. Until next time.